Hi, welcome to my channel once again. We'll be talking about inflation and taxation in discounted cash flow. When we talk about inflation is simply increase in prices leading to a general decline in the real value of money. So why inflation in cash flows? Inflation is necessary in cash flow computation because in terms of inflation, the fund providers will require a return made up to two, made up of two elements, and one of the elements is that real return for the use of their funds. Investors will require real returns for the use of their funds. That is the return they would want if there were no inflation in the economy. And another is investors will require additional return to compensate for inflation where inflation occurs. So, inflation may be described as a general increase in the price of goods and services, leading to a decline in the value of money. So, it is a fall in the purchasing power of money, and inflation should be considered in ascertaining project viability if the cash flows arising from the project will be affected by inflation. So, inflation is very key concept in evaluating investment appraisal because time is a feature of all economies and it must be accommodated in financial planning. So, annual inflation in different economies and countries varies, and it is important to adopt investment appraisal method to cope with the phenomenon of price movements. So future rates of inflation are not likely to be precisely forecasted. So there are two types of inflation and can be distinguished because we have specific inflation, which relates to the price changes of an individual goods or services. And also we have the general inflation, which relates to the reduction in the purchasing power of money. And it is measured by an overall price index, which follows the price changes of a basket of goods and services through time. So, talking about the types of inflation, as you can see on the screen, there are basically two types of inflation, and these include the general inflation and we have the specific inflation. To re-emphasize the general inflation, this is the increase in the average prices of goods and services in the economy, and it is usually measured in terms of changes in consumer price index and also general inflation affects both cash flow and the discount rates used to evaluate the investment. Now, talking about specific inflation, this is the changes in all the elements that constitute a project being evaluated. So, different inflation rates may affect revenue and production costs, such as direct material costs, direct labor costs, direct expenses, variable production overhead, and fixed costs. So, specific inflation affects only the cash flow of the projects, but does not affect discount rates that is used to evaluate the project. So the effect of inflation on cash flows. What is the effect of inflation on cash flows? So generally, cash flows can be classified into two, and these include money cash flows and real cash flows. Now, when we talk about the money cash flows, this is a cash flow that already incorporates the inflation rate. So it is the actual monetary amount paid or received in the year that the cash flow occurs. So each cash flow is adjusted by its specific rate of inflation. So the cash flow in terms of money, the cash flow that have inflation already embedded in them. So these are the cash flows that incorporate the effect of inflation. So money cash flows are inflated cash flows unless otherwise stated. All cash flows are assumed to be money cash flow in an examination situation unless otherwise stated. So also we have the real cash flows. These are cash flows that do not consider the possible effects of inflation. So this is a cash flow that is stated in real time. That is, inflation is not incorporated. With real cash flow, future cash flows are expressed in terms of constant purchasing power. So there are cash flows that is stated in terms of current year prices, today's prices, year zero prices, or year one prices. So also we have the cost of capital, type of cost of capital, types of cost of capital. We have the money cost of capital, and also we have the money cost of capital, and we have the real cost of capital. Talking about the money cost of capital, this is also known as nominal cost of capital, money rate of return. Yes. So it is the cost of capital that incorporates the possible effects of inflation. So money cost of capital is used to discount money cash flows of a project. We must note this, that except otherwise stated, always assume available cost of capital to be money cost of capital. So on the slide, I put that this is the cost of capital that incorporates inflation rate. That is, it is cost of capital plus an allowance for inflation. So money cost of capital can be computed as follows. That is using the Fisher formula, which is stated as the money cost of capital equal to the real cost of capital multiplied by inflation rate. Is 1 plus M equal to 1 plus R multiplied by 1 plus I. So to talk about the real cost of capital, this is the cost of capital that does not incorporate the effect of inflation. It is the cost of capital that is expressed in real terms. In real terms. So these are costs without the effect of inflation, and the real cost measures the return in constant price level terms. So real cost of capital is also defined as the rate of return that will be required in the absence of inflation. So real cost of capital can be computed if if money cost of capital and inflation rate is given. So it will be making the real cost of capital subject of the formula from this equation here. When you try to make R the subject of the formula, it will be what? It will be 1 plus M. It will be 1 plus M divided by what? 1 plus I. So you'll be left with 1 plus R. So to make R stand alone, you move 1 to the other side of the equation, which you change to minus 1. So you now have the equation in this form. You have the equation in this form. That is, real cost of capital will be equal to 1 plus M divided by 1 plus I minus 1. So also you can compute inflation and determine your inflation rate. How do you do that? By making these aspects 1 plus I the subject of the formula to be 1 plus M divided by 1 plus R equal to 1 plus I. To make I stand alone, the 1 here will cross to the other side of the formula to become minus 1. As you can see here, I is equal to 1 plus M divided by 1 plus R minus 1. You can write out the formula and try to practice this on your own. So we have some golden rules that we must adhere to. There are two golden rules when adjusting for inflation in investment appraisal. Two golden rules when adjusting for inflation investment appraisal. The 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 two golden rules. Number one is estimate the cash flow in money terms and use money discount rate. It means like goes with like. Money cash flow should go with money discount rate, and real cash flow should go with real discount rates. So where the examiner did not state the rule to apply, either rule can be adopted to achieve the same results. So also, let me include some other rules. Let me reiterate what I've said. That's cash flow stated in money or nominal terms must be discounted using money cost of capital. Must be discounted using the money cost of capital. Using money cost of capital. And cash flow stated in real terms must be discounted using real cost of capital. And discounting cash flows using money cost of capital and real cost of capital will give the same result of NPV with little variation due to rounding error. So when you solve questions that involve cash flow, when you use the money cost of capital or you use the real cost of capital, your answer will be near same, be near same. So where they are not perfectly same, don't don't disturb yourself. It's due to the rounding of errors. So money cash flow should not be discounted using real cost of capital because they are not, there is no matching issue there. And the real cash flow should not be discounted using money cost of capital. At year zero, both money cost of capital and real cost of capital are equal. So all cash flows are assumed to be money cash flows unless otherwise stated. So also note this as a form of summary. Where cash flows are stated in year one prices or first year prices, inflation should start from what? From year two. Inflation should start from year two. And where cash flows are stated in today's prices, that is in year zero prices, in current year prices, inflation should start from year one. I will show more of this as we proceed. Now we have this example here. We have this example that an investor is prepared to invest $100 for 1 year. He requires a real rate, a real return of 10%. He requires a real return of 10%. In addition, he requires compensation for loss of purchasing power resulting from inflation. So, which is currently running at 5%. Is currently running at 5% per annum. What money rate of return will he require? So, just to compensate for inflation, his money needs to increase by what? By 5%. And when his money increases by 5%, it will be what? This hundred dollar will be multiplied by what? The increase in 5% multiplied by 1.05. And to give a real return on top of this amount, it must further increase by 10%. And for 105 to increase by 10%, it will be what? 105 multiplied by 1.5. And you should have a real return of $115, 50 kobo or 50 cents. $115, 50 cents. So his money will increase overall by what rate? By 15.5%. Let's show this using this formula here. Let's show this using this formula. Let's show this using this using the Fisher's formula. From the question, we're trying to get the money rate of return. Now, this is showing your money rate of return. Now, the real cost of capital, as given in the question, is what? Is the real cost of capital is 10%. So replacing this R by 0.1, which is 10% in decimal, and the I, which is inflation, is giving us what? 5%. 5% in decimal is 0.05. Replacing that, we have 0.05. 0.05. When you multiply these two values, or you add these two values, let's see, we have it as this 1 plus m equal to what? 1 plus 0.1 will give us what? Will give us 1.1. 1.1. Then 1 plus 0.05 will give us what? 1.05. 1.05. When you multiply both, the result should be what? You should have the results in this order. 1 plus m equal to 1.1 multiplied by 1.05. You should have what? You should have 1.155. Now, to determine the money cost of capital, the money rate of return, you have to make m the subject of the formula. So m will be what? Equal to 1.155. When 1 cross to the other side, it becomes minus 1. When you simplify further, m will be what? M will be what? 1.155 minus 1. You should have a result in this order. You should have 0.155. 0.155. So for the investor to get the appropriate return, the money rate of return should be 0.155, which is same as what? 15.5%. 15.5%. So the investor's actual rate of return, should be what? Should be 15.5%. So you can see the money rate of return will be 15.5%, which is what? 1.05 multiplied by what? 1.10. So the real rate is what? It's 10%. The inflation allowance is what? It's 5%. So when you incorporate this into the formula above, into this formula, you're going to arrive at what? 15.5%. 15.5%, which you can see here. I hope this is very clear. So also, we have another example talking about money and real returns. That's $1,000 is invested in an account that pays what? That pays 10%. In an account that pays 10% interest per annum. Inflation is currently what? 7% per annum. Find the real return on investment. We should determine the real return on investment. We'll still come back to this formula. Still come back to this formula to determine the real return on investment. That is the real cost of capital. For us to determine that, just work with this formula. Just work with this. So to determine the real return on investments, it will be what? From this formula, you can make your R the subject of the formula. You can have it in this way. That is 1 plus what? 1 plus R will be equal to what? 1 plus what? 1 plus M. You divide by what? Divide by 1 plus what? 1 plus the inflation rate. So because you're trying to determine the real cost of capital, not the money cost of capital now. So when you do this, 1 will cross to this other side, and you have it as what? As minus 1. You have it as minus 1. Minus 1. So you just have only your R here. So you can use this to determine your real cost of capital or your real return on investment. So when you have this in this order, now from the question, your money cost of capital is what? The money cost of capital is what? That 1,000 naira dollar is invested in an account that pays what? 10% interest per annum. That is the money cost of capital. So for you to determine your real cost of capital, it will be 1 plus what? 10% in decimal is 0.1. 0.1. When you divide that by what? By your inflation rate. The inflation rate in the question is what? Is 1 plus 7% is what? 0.07. 0.07. So when you simplify further, you should have a result of what? It should be what? 1 plus 0. 1 plus 0.1 will give you what? 1.1. Divide by what? Divide by 1.07. So with this now, you can determine your real return on investment. So your R will be what from this? The value of R will be what? When you simplify, when you divide now, the value of R should be equal to 0.028. And in terms of percentage, it should be what? 2.8%. Should be 2.8%. So this will be your real rate of return. This will be your real rate of return. So also, you can have another example talking about money and real returns. That if the real rate of return is 8% and the rate of inflation is 5%, what should the money rate? What should be the money rate of interest? What should be the money rate of interest? You should bring back that formula again. This formula. At this point, you're trying to determine the value of M. The value of M. Now, in the question, you are giving what value? You are giving what values? For you to determine the value of M, in the question, you have your real rate to be what? That is 1 plus what? 1 plus 8%, which is 0.08. 0.08. And your inflation is what? Your inflation is what? 1 plus what? 1 plus 0.05. 1 plus 0.05. So when you simplify further, you're going to have it as what? As 1 plus M equal to what? 1.0808. When you multiply with the inflation value, you're going to have what? You have this as 1.05. So when you do your multiplication, you're going to have what? 1 plus M equal to what? 1.08 multiplied by 1.05. You should have 1.134. 1.134. So when you move 1 to the other side of the equation, to be M equal to what? 1.134 minus what? Minus 1. So the value of M will be equal to what? The value of M will be equal to 0. Will be equal to 0.134. 0.134. In percentage, M should be what? 13.4%. 13.4%. I hope this is clear. I hope this is clear. So I will share some of my assignments with you. Make sure you watch this and make sure you get this right. So the impact of inflation on cash flows. The impact of inflation on cash flows. Where cash flows have not been increased, by expected inflation. They are described as being in current prices. Take note, where cash flow have not been increased for expected inflation, they are described to be in current prices or today's prices. So where cash flows have been increased to take account of expected inflation, they are known as money cash flows. Take note, we've stated this before now. They are known as money cash flows or nominal cash flows. They are known as money cash flows or nominal cash flows. Remember, if they don't take inflation into account, they represent expected flows of money. Hence, the term money cash flows. So, you can assume that cash flows you are given in the exams are money cash flows unless told otherwise. If the examiner specifies that the cash flows are in current price terms, you will generally need to put these in money terms before you can discount them. Although see other methods of dealing with inflation below. Make sure you read the questions carefully. Sometimes you'll be given the cash flows in year one terms with subsequent inflation. You can see this. For example, if the questions tells you that sales for the next 3 years are $100 in current terms, but are expected to inflate by 10%, then what this actually meant is that the sales will be what? In year one, it will be 110. That is the effect of inflation on 100. It will be 110. In year two, it will be what? 121. That is 10%, 1.1 to the power of 2 multiplied by 100 will give you 121. In year three, it will be 1.1. That is 10% plus 1. 1.1 to the power of 3 multiplied by what? 121 will give you a 3 value of inflation. For example, if the question says that sales will be $100 in the first year, take note, inflation will not start in the first year, to start in the next year, but are going to inflate by 10% for the next 2 years. So the sales will be what? In year one, it will be $100. In year two, it will be 110. That is 1.1 multiplied by 100. That is inflation effect on 100. In year two, will give you 110. In year three, it will be 1.1 to the power of 2. Inflation effects on year two will give you what? 121. So the impact of inflation can be dealt with in two different ways. Both method gives the same NPV. So you can see it's methods of dealing with inflation. We have the real method. When you're using the real method, what do? Do not inflate the cash flows. Leave them in real terms, that is in today's terms. What do? How do you discount? Discount using the real rates, the real rates. When you are giving money or nominal method, nominal value, inflate each cash flow by the inflation rate. That is, convert it to a money flow. And how do you discount? You discount using the money rate. All you need to do is just to be consistent. When you're using the real cost of capital, you discount using the real rate. When you're using the money cost of capital, you discount using the money rate. Just be consistent. Be consistent. Now we have this example. We have this example that Stormco is evaluating project X. Stormco is evaluating project X, which requires an initial investment of $50,000. Expected net cash flows are $20,000 per annum. $20,000 per annum for 4 years at today's prices. At today's prices. However, these are expected to rise by what? 5.5% per annum because of inflation. The firm's money cost of capital is what? Is 15% per annum. Find the NPV by discounting money cash flows. B. Find the NPV by discounting the real cash flows. So using the money method, Discounting money cash flow at the money rate. Let's see what we can do with regards to this. Let's see what we can do with regards to this. So, solution. So the cash flows at today's prices are inflated at what? By what? 5.5%, as you can see in the question, that the net cash flows is this. However, they are expected to rise by 5.5% per annum because of inflation. So the firm's money cost of capital is 15%. It's 15%. So the cash flows at today's prices are inflated by 5.5% per annum for every year. So to convert them into money flows, what are we going to do? What are we going to do? We're going to have it this way. We'll have to discount the money cost of capital. We have to discount with the money cost of capital. Discount with the money costs of capital. So we have it in this way. The time, let's say we have our workings here, and you have your money cash flow. You have your money cash flow. At that point zero, year zero, where the investment is taking place, the outflow is what? It's 50,000. Now, the money cash flow will still be what? Will still be 50,000. Still be 50,000 at that point. So at year one, we're going to have it as what? The inflow at year one is what? 20,000. 20,000. What will be the inflation effect? 5.5% is 0.055. Now, to discount that based on inflation, today's prices, it will be what? It will be 1.055. 1.055. To increase 20,000 by 5.5%, it will be 1 plus 0.055, and you have 1.055. When you multiply, you should have a money cash flow of what? 21,100. In year two, you have same value of inflow, but based on inflation, in year two, it will be 1.055 to the power of 2. To the power of 2. At that point, you have to raise that value of inflation to the power of 2, because it is at the second year. It is at the second year. So you lift it up to the power of 2. So it's to the power of 2 once you. So 20,000 multiplied by 1.055 to the power of 2. The result should be what? Should be 22,261. So in year 3, it will be what? It will be 20,000 multiplied by what? 1.055 to the power of 3. To the power of 3. 1.055 to the power of 3. Once you compute that on your calculator, you should have, and multiply by 20,000, you should have what? 23,485. 23,485. And in year 4, it will be what? In year 4, it will be 20,000 multiplied by what? 1.055 to the power of 4 to the power of 4. And when you multiply, you're going to have what? 24,776. So these are money cash flow. Note, the question simply refers to the firm cost of capital. Yes, the question simply refers to the firm's cost of capital, firm cost of capital. So you can assume this is the money rate. So if you are given a real rate, the examiner will always specify. The examiner will always specify. So having determined this now, you can now get your present value. You can get your present value in this form. You can get your present value. You can get your present value, the time. Let's show our workings here again. Then the discount rate given in the question is what? 15%. 15% discount rate given, and our present value will be what? So at the period of 0, we have an outflow of 50,000. The discount rate will be 1. The present value will be what? Will be 50,000. 50,000. In year 1, our money cash flow as computed is what? It's 21,100. 21,100. 21,100. The discount rate will be what? When you discount 15% based on year 1, you should have 0.870. 0.870. Then the result will be what? 0.870 multiplied by 21,100 should have 18,357. And in year 2, as computed, the value will be what here? 22,261. 22,261. 261 multiplied by the discount rates of 15% in year 2. You should have 0.756. When you multiply by 22,261, you should have 16,829. So in year 3, the result will be what? In year 3, you can have it as what? As computed. The money cash flow is what? 23,485. 23,485. 3,485. When you multiply and you discount 15% in year 3, you should have 0.658. 0.658. And the present value will be what? 0.658 multiplied by 23,485. You have 15,453. And in year 4, the result will be what? In year 4, the results will be what? In year 4, the computed money cash flow is what? 24,776. 24,776. The discount rate will be what? In year 4 should be 0.572. The PV will be what? 0.572 multiplied by 24,776. You should have 14,172. 14,172. So the NPV will be what? The NPV, when you add the positive and less the negative from it, your NPV should be 14,811. 14,811. The NPV should be 14,811. So this is working based on the money cash flow. Let's now see using the real cash flow. Let's see using the real cash flow. let's see, discounting the real cash flows, we're going to have similar answer. The real cash flows at the real rate, at the real rate. So we're trying to use the real method now. Trying to use the real method. So calculate the real rate by removing the general inflation from the money cost of capital. Based on our formula, based on this formula, your real rates will be what? You make this the subject of the formula, the rate subject of the formula, that is 1 plus what? 1 plus R, 1 plus R equal to what? To be equal to 1 plus M divided by what? Divide by 1 plus I. So when you do this, you now have it as what? To make R subject of the formula, the one we cross to the other side. The one we cross to the other side, and it will be what? To be minus. To be minus 1. Minus 1. So you can use this now to solve, to determine the real rates. The real rates. And for you to determine the real rates based on the question, you have it as what? Your money cost of capital as given in the question is what? It's 15%. It's 15%. So when you substitute, R will be equal to what? R will be equal to what? We have it as 1 plus the money cost of capital is 15%, same as 0.15, divided by what? The inflation value given in the question, which will be what? Which will be 1 plus the inflation value is what? 5.5%, and that will be what? That will be 0.055. So when you simplify this, 0.055 minus 1. When you simplify this, you should have what? When you simplify this, you should have R will be equal to what? R should be equal to 1.09 minus 1. So R will be what? R will be what? 9%. That R will be equal to 0.09. So, and that should be 9%. That should be 9%. So you can now apply this real rate as a discount rate now. As a discount rate. Apply this real rate as a discount rate. So when you do that, we have it in this form. We have it in this form. Time, the real cash flow, and we have the discount rates. Now in this case, the 9% will serve as a discount rate, and the present value, we have it as what? Now in year zero, the real cash flow will be what? Will be 50,000. Be 50,000. The discount rate in year zero will be 1, and the present will be what? Will be 50,000. 50,000. Now, since we have a constant flow of 20,000, based on the annuity, When you use your native formula to get the discount rate from year 1 to 4, you should have 3 point what? 3.240. 3.240 based on 9%. Based on 9%. And so 3.240 multiplied by 20,000, you should have what? You should have 64,800.